Hi, my name is Todd Kniazuk. I'm the Executive Director of Art Services Initiative of Western New York. Thank you for all being with us today. I love this room, so thank you to Don and all the folks here for hosting us today. With the material we're giving to you today, if you start daydreaming, at least you have wonderful things to daydream. Granted, today's material is not perhaps the most interactive kind of things like if we did our marketing sessions, but very important information and information that's really going to be critical for all of you, not just with the Erie County application. I mean, this is one of the materials in this session are things identified by the county as places where the field in general could improve a bit as they go through their county application process. But the common denominator in everything here and in our governance session is that they're all also things that are incredibly important for us as culturals in the running of our organizations. And so that's really why we're all here today. I want to thank our sponsors, the New York State Council on the Arts, Erie County, and Fund for the Arts. They make this possible, free and open to the public with everything we do. So thank you to our sponsors. And coming up at ASI, we do not have a date set yet. It will be sometime in June or July. We're working with our keynote speaker on it. We'll be offering our next organizational training. Will be about member services. So it will be about how we serve our members or our season ticket holders and how we think about that customer service aspect. And we believe a lot in peer learning, but sometimes the peers we can learn from aren't all in the cultural sector. And so actually the Buffalo Bills organization will be our keynote speaker on that, and then we'll flesh out a couple other panelists to go with that. And they'll talk a little bit about how they work with their season ticket holders, distinguish between basic and premium holders and such, and serve their constituents. And well, the camera's on, but the heck with it. You got to think, right? I mean, if they can do as well as they do with season ticket holders and premium holders, and they've had a product that hasn't been successful in a decade and a half, right? I mean, we can probably learn a little something from them, but don't say that when you get here. We're going to be very nice to them. Nice. You can come to all of our sessions for free. Anyway, so with all of that, and then August 7th is our next session for culturals, and that is going to be the release of Arts and Economic Prosperity 5. It's the release of the Economic Impact Report of nonprofit cultural organizations and their audiences. Thanks to all of you who let us in your doors over the last year, and thanks to our staffer you met on the way in, Natalie Brown, for really taking the reins on that project with my other staff at Parish. And collecting all the audience data and the organizational data. But we're going to have Randy Cohen, the Director of Research from Americans for the Arts, in to release that data with us. It's part of a nationwide study. The nationwide part will be released in June at their annual convention. And then we took a look at the 5 counties of Western New York, and it's good. I mean, we've seen preliminary data, and our impact is pretty strong. So. Which is good because we kind of say it is, and now we can prove it. So with that, let's get into today. It's broken up into a few parts. I'm going to take the very first part, which we're going to try to do really practically, and it's kind of the teaching part, right? I mean, lots of this is kind of like, how do you read a balance sheet or a financial statement? How do you look at your 990s and make sure you're not making mistakes on it? The one piece that was a little different was the idea of the cash flow forecast. And in a very kind of practical, down and dirty way, we wanted to take you through what it is and how you create it, especially with a mind for small to mid-sized organizations. So I'm going to take that piece, and I will first say I am not an accountant. So for me, this is more about sort of taking that budget as written and what you do with it to translate it into a cash flow forecast. So here it is, and so really the whole idea of cash flow forecasting goes back to that old saying, right? I can't be broke, I still have checks left. And what that means is, we put together a budget, and even if that budget is absolutely true, right? So even if we get that right, all the money we thought we were going to raise, we're raising, we control our expenses, we don't go a penny over our expenses, we can still be out of money at different points during the year. We can still run into a problem where we can't pay the bills. And that kind of vexes folks. Well, how can that be, right? Well, that's because of these cash flow forecasts. And so the idea of cash flow forecast, all it is really simply is it's breaking down your spending and your revenue either by month, or if you're a very small organization, maybe by quarter. I mean, if you're of the level where you really do, let's say, 2 things a year, right? I mean, you maybe have a fall show and a spring show and that's it. Maybe you can go quarterly, but for most organizations, it's probably monthly. They give you a clearer picture of your income and expense each month. And the key there is, that starts with having a knowledge of your budget. And there's no trick or tip. I'm going to give you some tips later on some of this, but you have to understand your budget. There's just no way around that, right? And there's ways to get in there and start to understand it better if you don't really have a clear picture, and that we can help you on a little bit, but really, in order to extrapolate out by month, it starts by you knowing what it is you do. Any of you, though, that have heard me talk about budgeting, know that I don't look at budgets as numbers. I look at budgets as programs and people and policies. Policies being the things that we kind of have to do. We have to pay rent, we have to buy insurance, we have to be compliant with filings, and those cost money, right? I mean, our programs are the things we do, and the people are the resources we need to do those things. When you start to look at that, just like you would plan an event, really budgeting is just that, but it's the numbers associated with that. So for anyone that wants to get deeper into budgeting, that's a separate session, but we can certainly follow up with you either individually or in another group session. You'll be getting a feedback form, and if you want to go deeper into that idea behind budgeting, just let us know on the feedback form. But again, it gives you your clear picture. It identifies months where your expenses exceed your income or vice versa. And that's back to that idea of I can't be broke, I still have checks left. It's okay, right? I mean, chances are your budget is not going to balance itself within every single month, even if you have an overall yearly balanced budget. The trick is making sure that you don't have too many of those months where your income is falling behind your expense, and those months are back to back to back to back, and all of a sudden you run into a problem because, well, I've got that big grant check coming, but it's not coming for another 4 months, and in the meantime, I've planned my biggest show of the season, and I've got all my annual renewals of all of my insurance and everything else, and I've got my employee bonuses. Well, you've put 3 big expenses in months before your big revenues coming in, right? And so understanding and identifying where those months are. Now, that doesn't change your overall budget, right? I mean, so we're still talking about you using your budget as approved by the board or as written, but it may start to influence where you put certain things within the year. If you're a theater and you're planning your next season and you've got, a particular show that's, a 10-hander, and it requires, some multimedia, it requires, a lot of production. And then you've got another show that's a 2-hander, and it's going to be people costumed in black against a black backdrop. That may help you think about where do we want to make the expenses on the big show versus where do we want to make the expenses on the smaller show. There are, of course, other factors that factor into that in terms of marketing, in terms of building a season and crescendo from a programmatic standpoint, but we're not here to talk about any of that. We're here to talk about the finances. So as I said, it helps you to place things, and as you're thinking about launching new things, right? If you're thinking, we need to have a new fundraiser or a new individual giving campaign, looking at your cash flow forecast and looking at some of your past year performances, this can really help you place where you're going to put that new revenue generator. Because you can put it someplace that helps boost up a time of year when you're not cash flush. And that's important because, a lot of our revenue isn't really controlled by us. When we get grants, it's the grantor who tells us when we're getting the money. In extraordinary circumstances, and actually in Western New York we have wonderful grantors, both in government and in foundations, because under extraordinary circumstances they're actually willing to take a phone call from you and listen to you about, needs, urgent needs. But the problem with that is that those urgent needs become annual urgent needs well, that kind of indicates that you're not doing something like this well or not doing it at all, right? So, you know, we leave it for those extraordinary circumstances, but normally there's ways to control not having to call someone up and say, oh my God, I really need an advance on that. So these are sort of some of the core reasons to do cash flow forecasting. And by the way, at any given point, you know, stop me and ask a question. It can be kind of fluid. So that's kind of.
Is it good to chart it out in a graph chart rather than numbers to see where the high?
Well, I'll actually give you I'll take you into some. I mean, you certainly can. That's another way. That's a way to kind of put it into a visual representation. Different way of presenting it, perhaps for your board or your finance committee, if they're not getting what you're trying to explain to them in some way. But it becomes pretty self-explanatory with a model I'll show you in a second. What it isn't. So a cash flow forecast is not the same as a cash flow statement. All right, so there's such a thing as cash flow statements that our accountants produce that are like retroactive, that tell you how you did. This is a forecast of your budget. So they are not one and the same. And that's kind of a common attachment mistake that all kinds of nonprofits make on grants is, you know, it says, hey, attach your cash flow forecast, and someone attaches a cash flow statement generated out of QuickBooks. Not the same thing. And my staffer made that very, you know, visually clear. Yes. I don't know which is which though, but all I know right now is I'm hungry because I didn't have dinner. So anyway, yeah, they all look very good, don't they? Anyway, all right. So a couple of ways to do it, and again, you know, please, especially Mike sitting here, who's, you know, an accountant and an auditor and everything else. When I put this together, I meant it to be really for all of us as not accountants or auditors, but people who probably in our organizations have to deal with these sort of things, to be able to deal with these sort of things. And so in thinking about this, I kind of think about it one of two ways. One thing you can do is you can actually use the cash flow forecast to create your annual budget. So if you wanted to, you could, you know, start by trying to plug in all of those month to month things, and you know, you add those all up and there's your budget. Or you can start with your completed annual budget. You can start, or your draft annual budget, and sort of extrapolate out into the months. For me personally, I do it that way, simply because when I'm trying to, it's hard enough to get all the numbers right on an annual budget and make sure you're not forgetting anything and such. So first, let's get all the numbers on the page, right? And then we can start to move them out in month to month. Because again, remember, you know, you can adjust within. You can think about, oh, I might want to move that fundraiser up a month, or I might want to delay that expense if I can by a month, when you start to see the effect of your budget into all of the months through a cash flow. So it's not like you're automatically going to radically change your budget based on, you know, on what you see in your cash flow forecast. You're just going to play within, right? So I really do like that it's just, I think, a little more manageable, but feel free. I mean, you know, because in some ways then you're saying, well, we've already created a budget, now we got to do a cash flow. This does cut down the work to some extent, because you get your added numbers at the end, but to me it's a little bit more complicated, at least for me, but you guys might be better at that than I am. So what it looks like, we'll go right to here. So all this is, now this looks scary. This means, oh good Lord, what is all this? But all this is, it's two things. Down here, this is just like ASI's budget, right? So, you know, don't worry if you can't read all of the individual lines, because it doesn't matter what our lines are, it matters what your lines are, right? So it's just taking the lines of your budget, and that's what this axis on this chart is going to be, is the lines of your budget. And this is just the months of the year. And then there's a total column at the end. This is literally the template for putting together a cash flow forecast. So it's nothing scary. It's the months of the year and it's the lines of your budget. If you want, you can add a line here where you actually put in the total on one more time, right? So you can take the total from your budget, so you already have the number, and put it here. And then, you know, you can create formulas on your Excel sheet so that as you add in numbers here, it'll autofill there. And so now you've got your check and balance, right? Because after you've added all your numbers across, the number that you get on the right-hand side in the auto sum should be the same as the number you put in here from your annual budget. If it's not, you go back in and play around with it a little bit more until you get it there. But that is the template. So any questions on that? We can, well, I'll start to go into how you fill that in now. But
Did you use an Excel file for that?
oh yeah, that's just an Excel sheet. I mean, we put it into QuickBooks. You know, we do put our budget and our cash flow forecast into QuickBooks. This is actually a good time to mention that because that's a way then to generate budget versus actual reports for our finance committee and for our board and for ourselves too, that go deeper than just the annual, right? I mean, if you put your annual budget in and you know, you generate a report for the first quarter, well, how do I know really if I'm doing as well as I thought or not doing as well as I thought, if the only thing I can compare the actual to is the annual budget, right? That doesn't tell me a lot. You know, because you might say, well, but you're you know, a quarter of the way through the year, so you should be a quarter of the way through your expenses and revenues. Unfortunately, that's not how this works, because your main fundraiser might not be until September, right? Your first check from a funder may not come till April. So you may not necessarily be a quarter of the way into your revenues by the end of March, right? If you start to put in the month to month, now you've got a better picture as to what, you know, as to whether or not you're playing in the same ballpark you thought you'd be playing in. And that also then makes it easier to understand why, right? Because ultimately it's about why, right? I mean, if I am running behind, am I running behind because we underperformed on something? Or am I running behind because I thought I was getting that check in March, but it actually is coming in April? Right, well, okay, that's not bad. We're not actually really running behind then. And that's an easy way then to communicate to your board that we're still okay, just because you're seeing that our revenues aren't quite where we expected them to be. Yes?
So the benefit of doing this is really understood on the very bottom line, the total surplus / deficit for each month. That's where you're getting this information that's going to be useful.
Mm-hmm.
Okay.
Right, so of course, you know, we create an annual budget, we want it to balance, right? But when you're adding in each month, and you're gonna get to your total surplus or deficit, you'll see that again, not every month will balance. It'll be actually a shocking coincidence if there's a particular month that balances. At the end of the year, it should balance, but within there absolutely are months when income is gonna exceed expense and months when you know, expense is going to exceed income. That's perfectly fine, but that's going to give you that idea, and you can start to look at that and say, I mean, usually beginning of the year is a slow time, right? I mean, you know, you're waiting for those first payments on your grants, your end of the year campaign is over, but you still have all your regular bills. So, you know, it's fine. In January, if we're running behind, but if we're running behind January, February, March, and April, wow, can we really go a third of the way into the year before our revenue catches up to our expense, right? I mean, without going into a line of credit or without going into our savings account or whatever, you know, you got to think, is that okay? Is that how we want to operate? Are there things we could move, though, to alleviate that pressure? There may not be, but if there are, we can alleviate it.
So you probably don't start the year at zero, so where would you put that starting amount for your expenses in January?
Yeah, I mean, again, I like to kind of keep it clean because I want to understand what my budget looks like, but you're absolutely right. I mean, one of the factors is, do we have money in the bank that can cover a bit of this, right? Or do we have a line of credit if we need to go into it? So there are other ways to get to a point where, you know, we're covering some expenses for a couple of months. But I like to actually give it a clean look for the year because, again, I don't want to become overly reliant on those sorts of things, just in case.
Pick up on Mary Ellie's point, if you start the year with a certain amount of cash, knowing that there will be months that will be slow or soft, that's fine. You just have to subtract it out at the end of the year to acknowledge that you started the year with a certain sum of money. And the other model is retailers who make fiscal year positive through back to school sales or holiday sales. So there are financial models that say we're going to have 2 really good times of the year. The rest of the time we're running a deficit every single month. It could be a deficit of 11 months in a row, but the holiday season takes us over the top. Well, if that's true, you need a pretty good sized number at the front end to carry you through those lean
Right,
times,
right.
but then subtract it out at the end of the
Right,
fiscal
right,
year.
right. And you also better hope that you then don't have a snowstorm if you're waiting for your Christmas sale to be the one good time of year. I mean, it's, you know, and again, that speaks back to the idea of trying to, you know, because again, if we're creating an annual budget that is balanced and we're not, you know, deficit spending in our budget, we're not intending to lose money in the next year, wherever possible, if we can make some adjustments to get as close as possible to being self-reliant, you know, that then kind of girds against the idea that if we do have a bad year and all of a sudden our reserves are down, right, or if our interest rate goes up on the line of credit, we really don't want to use that. You know, if we're reliant on it every year, with some exceptions. I mean, some organizations are just going to have to run that way. But if we can become as self-reliant within the year, contained within the year as possible, that really helps us guard against those, you know, unfortunate extreme circumstances. All right. Here we go. So, and again, you know, feel free as you go, once you get comfortable with it, to use whatever method works best for you. This is just a way that I do things that makes it easy for me. But your organizations will be very different, and you may want to lead with different things. Yes.
So you have to predict what your earned income's going to be?
Absolutely, yeah, but you have to do that in your budget anyway.
Right.
Well, you would, but I mean, exactly.
Well, it's a planning document, right? So I mean, you know, just like
So
your
you base
budget.
it on last year.
Yeah, well, there you go, yeah, I mean, that's one really good way to do it. We'll get to a couple of those things. But I mean, really, remember, we're already starting with a budget. It's already starting with the idea that we are predicting our expenses and revenues for the year, right? What I like to do is I like to start with the monthly expenses, right? Because that's a great way to autofill some of those lines. You know, and get some of your lines taken care of real easily, right? Personnel, like salaries and fringe, right? But don't forget that there's 26 pay periods in a year, right? And, you know, so there are going to be 2 times throughout the course of the year when you have a slightly larger figure in salaries and fringes than in the others, right? So it's not just dividing your salary and fringe by 12 and putting it in there. So you got to watch out for that one. But other than that, salaries and fringe can go right across with those 2 bumps. If you pay your monthly rent or pay your utilities monthly or quarterly, easy way to kind of get those kinds of things set in there. You know, things like legal and audit, if you have, you know, if those are monthly things, whatever, leases or loans or bank fees, that kind of stuff. So if you know you've got monthly payments, get that stuff in there, right? I mean, you can cross it off on your budget. So anything that's monthly, put it in there. And then the next thing I do is I go to the once a year expenses, right? So if I don't pay my insurance monthly, if I just pay the premium once a year, that's exactly going back to that idea of like, oh, but I don't quite remember when that is. Go back to your last bill, right? I mean, your past is the best part of planning for your future. So go back and see, when do I pay these things? And again, that gives you the, you know, as you start to look at it then in the context of cash flow forecasting, you might be able to see, well, all right, I mean, I do pay my insurance bill every year in this month, but I actually could pay it in this other month, and that would be okay. All right, you know, you find places where you can start to make those adjustments without being delinquent, especially in insurance. But if you have a once a year audit cost or professional memberships or bonuses, you know, and you know, so there you're really just thinking about what month you pay those bills, and you're entering it in, right? So nothing extraordinary here, right? No. So entering all of the rest, there's a couple good options. So going back to that template I gave you, right? You can either go line by line on your budget, or you can enter by program, right? So, you know, in our budget, for instance, we have different classes within, or programs within our budget. So we have our professional development, we have our advocacy work, or we have arts access. And so I could go into arts access and enter all of my arts access revenues and costs into that cash flow. The thing about doing it that way, though, is you've got to really kind of keep good notes for yourself about what you've entered and what you haven't entered, because you're going to start to see, well, that marketing line now has some numbers in it, right? But did I put all of the programs in there? Which ones did I? Which ones didn't I, right? So, that one I think needs a lot of good notes. The way I do it is I actually go line by line on the budget. So I look and I say, all right, I'm gonna put the marketing and communications line in there. Now I start to look and say, well, all right, we have our Make Music Day in June. So, okay, most of our marketing for that then is going to be in June. But wait, is there some of it that hits in May? There is, okay, so I need to think. Some of it goes into May, some of it goes into June. If we have our Spark Awards, our big fundraiser in May, when do those sponsorships come in? Right? So sometimes people are really simplistic with this and think, oh, well, the event's in May, all the revenue and expenses, I'm just gonna put it in May. Is that really true though? Right? I mean, hopefully we're getting sponsorships in March and April. And unfortunately, we'll have to chase after some, and some are gonna come in June after the event, right? Our expenses, we have to put down a deposit on the hall early, January, right? And then we pay the main bill in May. So you think about the nuances of some of those. So I start to try to go line by line on that budget and check things off, right? Again, what that speaks to is understanding your budget and hopefully kind of understanding all of the different components within your budget. That if you've got a marketing line in your budget, that you understand how much of it is season-long marketing, how much of it is for a special event, when do some of those things hit. Those are the kinds of things you have to be thinking about in order to get your cash flow right, or as right as it can be. So as I said, and that way too I can close out lines, right? Like I know I've done marketing, whether it's for a program or general operating, whatever, I've done marketing, it's done, close out that line, move on to something else. And so as I said, don't forget the nuances of your budget. So taking our fundraiser mainly because it just happened, so it's kind of top of mind for us. Kind of thinking about when does that hit? Going deeper than it's in May, right? Like I said, when are sponsorships coming in? When do we pay the bills for it? And that's, it also, I would share these sorts of thoughts. Like I use this kind of work and I make notes to myself as an executive director of things I then want to follow up with other staff that actually have nothing to do with cash flow and budget. Right? But I mean, I'm making a note to myself when it's a good reminder, boy, the bill for all of the catering will hit as soon as the event hits. That's going to be a $20,000 bill I have to pay in May. I darn well need to prepare for that, right? I mean, so we've got to make sure we're ready for some things like that. Our organization's a little unique dealing with those re-grants that we give out to folks. So we've got to make sure that at the time those grants are going to go out, the money's in. To be able to give out $100,000 in grants, right? I mean, now NISCA makes us keep a separate account, which is not a bad idea, keeping things separate for yourself on some of those major expenses. So thinking about, again, my fundraiser example, you may want to really be thinking, again, how much deficit am I running in the months leading up to it? If the only sources of revenue are some of those sponsor checks from the event, but I know I'm going to have to pay a really big bill the month of the event, that might run into some problems, right? So it's really, it gives you a way to plan, not just your finances, but sort of be thinking then about, are there other options, right? Like, do we want to, is there a payment plan for something? Or, again, like if maybe we need to clear programmatically that month, because we've got that really big bill coming in. We don't want to have another really big bill coming in for something else. So let's move that. So that becomes a planning and programming talk, not just a budget talk. And again, and that's kind of, to me, some of the hidden usefulness in this. So again, just want to reinforce this one more time. The key to all of this is understanding your budget, but also understanding what your organization does. And as executive directors, if you're fortunate enough to have a few staff people with you, you may not understand everything about each of your programs. So this becomes a conversation with your staff. If you have a staff person who's coordinating a program, talk with them and understand when they need the resources. Because otherwise, you're hindering their ability to do their work. right? If when they're ready to market their program, we don't have money for them to market their program, but yet it's a balanced budget, but I can't free up money for you until the month after your program happened, that's useless, right? So, and that becomes more important as we're talking about smaller organizations, right? Because there's less of that bank account to fall back on, or less of the, well, we can just adjust from one thing to another, right? I mean, we have to know that we'll have the resources to do what we want when we need. Again, it's a planning document, back to your point. It will change, just like your budget will change, right? I mean, so if you've got a board that, you know, looks at January and goes, you are $32.95 behind where you projected you were going to be this month, have me come in and talk to them, please, because, you know, it is going to change. Of course it will change. However, reflecting back on it, if you're swinging wildly from where you thought you would be to where you actually are, that needs a deeper review, right? That needs a deeper look. First off, are there real problems? You know, like, are we really just, for some reason, not generating the income and expense we thought? That's a whole different conversation. But part of it is, do we really have an understanding of when these revenues are supposed to come in? Not just by looking at a contract, for instance, on a grant, but looking at the last few years. When does that check really come in? Right? So let's put it in for the month it really comes in, not the month they said it was going to come in, or we hope it comes in, right? I'm kind of talking about any of our NISCA-funded organizations for several years, the late payments on NISCA. I mean, it got to a point where I was just not projecting the first check until midway through the year. And even that was optimistic. You know, you start to make some of those, you know, they've gotten much better, thankfully, but, you know, you make some of those adjustments. So it's a way not only to project forward, but to look back and say, how are we doing on this? And what do we need to adjust for next year? So again, that's a way to review your programs and events through a lens of finances, and you'll avoid being broke even with a balanced budget. That's kind of what I've got for you on cash flow forecasting. Again, not overly complicated, not overly technical, but really a way to understand. So, any other questions? Yes?
I'm just curious, why does the county want this as part of the application? I mean, how does it affect getting a grant from the county?
Would any of the county folks like to take that one? I don't want to speak for you.
I'd be happy to answer.
Please,
The
Catherine.
county executive asked for it specifically because organizations have gotten into cash flow dilemmas and asked for money early. So that puts a strain on the county making their payments if somebody goes out of cycle. So they want to make sure that organizations are well managed, which is why you are asked for a strategic plan, but also the cash flow forecast, that you know when your events happen, when your annual fund happens, when your membership renewals happen, when your sponsorships happen, when does the cash come in? It's much easier to know when the cash goes out, but to make sure that you actually are planning for the cash to come in and doing the appropriate work to make that happen. So that is directly from the county executive.
And, you know, going beyond the grant, as I said at the beginning, it really is, to me, one of the critical tools of you know, good financial management of your organization. I mean, it's something that, you know, the number of organizations that I've seen as I come in and work with them who really have a problem because they're coming into these cash crunches, but they can't understand why. Because they're not, you know, they're like, all of our sponsors are coming, all of our, you know, it really comes down to that planning. You know, it's not enough to say, you know, in the course of a year, you know, and again, that's where I said though, that sometimes you can adjust that monthly to quarterly to reflect the size of your organization. If you're really a small organization and you're doing a fall show and a spring show, you know, you may not need to.
We actually recommend that it's quarterly.
Yeah, so, you know, but for a large organization, I mean, I really think, you know, understanding the monthly can help, because within a quarter, you know, you can go kind of deep, especially if you have some of those big annual things hitting. The month-to-month expenses, not so much. The big annual expenses can kind of catch you, you know, and so it's understanding, am I renewing my annual in December, or am I renewing it in January? Right, I mean, that takes you in a different, you know, at the end of the day, you still have to have money in the bank no matter what you do, but that's either, you know, first quarter or fourth quarter expense, depending on, you know, what they like, or if you want to take advantage of like some of the early renewals, you know, where you get a discount. right? And I've seen that too sometimes. It's like, oh, I would have loved to save that money, but I didn't have the money to pay the bill at the time. So I'm paying more money to renew this thing later as opposed to taking advantage of the early bird discount. We'll start planning for that. All right, we need all the money we can get in our organizations. Any other questions? Excellent, so that's my part. So that's the kind of hands-on part, and now we're going to get even deeper into looking at, reading, and understanding financial statements. So I want to introduce Michael Smith. He's with Amato Fox. He is ASI's auditor and works with a number of cultural and nonprofit organizations. So thank you for being here, Mike. Take it away.
Thank you, Terry.
Yeah.
That's the power button. Press it one more time.
Always hire younger people to work the technology.
All right, Todd, again, my name is Mike Smith. If anybody has any questions, just raise your hand, give me a yell, stop me. There were some handouts out there. I hope that I'm going to be using, so it'd be very helpful if you have one of those.
Does anyone need them?
Which one?
Other than me?
There was a handout, financial statement handout, and then some handout on the Form 990, along with the instructions for the Form 990. All right, now Todd was talking about forecasts. I'm gonna talk about the financial statements first. That's this XYZ organization incorporated. Todd was talking about forecasts. That's looking ahead. What I'm going to be talking about are financial statements, which is basically looking at the financial affairs of an organization for a specific time period and at a specific time. Now, I created this fictitious company, XYZ organization, and these financial statements are for the years ended December 31st, 2016 and 2015. Now, if you go out to a bank and look for financing, or if you look for a grant, typically they're going to want to see financial statements. And it's important that you understand basically how to read a financial statement. That's what I'm going to be talking about. Again, these are comparative financial statements. They're for the years ended December 31st, 2016 and 2015. So just starting on page 1. Now, these are audited financial statements, but a CPA firm, an accounting firm, they can provide you with other levels of service. Basically, there's 3 levels of service. The accounting firm can compile your financial statements. Basically, they're just taking the numbers that you provide the accounting firm, and they're putting them in a financial statement format. They're not providing any kind of assurance on those numbers. So that's the lowest form of service that the accounting firm can provide for you. There's another level of service called reviewed financial statements, and basically the accountant is taking your numbers and they're basically looking at those numbers just basically to make sure that those numbers make sense, okay? That there's no obvious errors in those numbers, but again, those numbers are not audited. The third level of service is a full-blown audit, where the accounting firm is looking at your numbers, and they're providing, or they're basically they're auditing those numbers. They're making sure that the bank reconciliations tie out, that your receivables are all accounted for, that your liabilities are all accounted for, and this is on page 1 and page 2 is an actual example of independent auditor's report. And the key, the first paragraph just kind of talks about the report on the financial statements. The second paragraph talks about management's responsibility for the financial statements. The third paragraph talks about the auditor's responsibility for the financial statements. Moving up to the first paragraph on page 2 is the audit opinion. And in this case, the auditor is stating that the financial statements referred to above present fairly in all material respects the financial position of the organization as of such and such a date in accordance with generally accepted accounting principles. So when you give a bank or a financial institution or a grantor a copy of these audited financial statements, they can basically provide, they'll basically have some assurance that everything that's reported in these financial statements are correct. Moving on to page 3. Let's look at the financial statements. I guess just give you a basic overview of the financial statements. Now these are audited financial statements, so we talked about the auditor's report. And on page 3 is the first financial statement. This is the statement of financial position, otherwise known as the balance sheet. On page 4 is the statement of activities, otherwise known as the income statement. And on pages 5 and 6 are statements of functional expenses. On page 7 is the statement of cash flows. So these 4 financial statements make up the basic financial statements of this particular organization. And then on pages 8 to the end are the notes to the financial statements, which basically gives you a brief overview of the organization and the accounting principles that the organization follows. And going on to page 9, it also provides you with more detail with regard to some of the numbers that are in the financial statements themselves. So we'll go back to page 3. Now I wrote in, I got some handwritten notes on these financial statements. That, I wrote these in here that'll, my hope is that, it'll help you understand how the financial statements work. The statement of financial position, again, otherwise known as the balance sheet, it lists all the assets of the organization. It also lists the liabilities of the organization. And at the bottom, it sums up the net assets of the organization. The basic accounting calculation here is your assets minus your liabilities equal your net worth. So for this particular organization, if we take the total assets of $986,215 for 2016, and we subtract out the total liabilities of $114,276, we come up with the total net assets, or the net worth of the organization, of $871,939. Basically, in just looking at this, if you were to give this financial statement to a bank or somebody who you were looking to obtain some financing from, or from a granting organization, these numbers look pretty good. I'm sorry? Are they hiring? There was one question, and going back to Todd's presentation on his forecasts. You were asking where would you start, okay? Okay, let's go back to 2015. Now, these are comparative financial statements, okay? So, let's go back to December 31st, 2015. This column of numbers here for 2015, that's your starting point, okay? Now this is going to list, your starting point for cash is $585,899, okay? Your total assets for 2000, as of 12/31/15, was $926,277, okay? Now, your liabilities, which will be, be paid, they're liabilities because they're gonna be paid after year end. Those total up to $101,413. And the net worth of the organization as of 12/31/2015 was $824,864, okay? So going back to 12/31/15, if you're gonna wanna, project, that's your starting point. And then what you would do is, when you're working on your budget for the year, you would look at your income statement, which is on page 4. So for 2015, we had all these revenues, starting with the $441,519. Okay, we had all these revenues for the year, so we're going to want to project those forward to 2016. Okay, so we start with our starting point with the numbers on page 3, and then we look at our actual income statement numbers on page 4, and then you use whatever methods you use to project forward how you think you're going to do in 2016, and you break up those numbers, in the monthly format that Todd talked about. Okay. Now you're probably not going to come out exactly to the numbers in the 2016 column on page 4, but you're going to budget those numbers, and that's that's your tool for operating your organization. Okay. Again, these financial statements look at our snapshot back in time, so they're not forward looking financial statements like as what Todd was talking about.
And just one little thing, on this, as Mike said, keep in mind that if you are kind of using this as a starting point and building in your cushion, in your cash flow forecasting, make sure that you're only looking at things like your cash, not your assets, right? I mean, if you look at that total number, well, that includes property, equipment, and everything else, right? And no one's gonna be happy if you try paying them with a chair, right? So, so make sure that you're careful in your, and then furthermore, of that, what's temporarily restricted? What do you have that's really available? And so if you do decide to use that as kind of a starting point to give yourself, some leeway in those first few months or whatever, make sure that you're using the right subset number. And then, so you put that in at the very beginning, and then make sure at the very end you're subtracting it back out, so that your budget is still, is still your budget, and not relying on draining down your bank account. Sorry.
All right, let's go back to page 3. We'll get into a little bit of detail as far as what makes up your statement of financial position or the balance sheet. Now, your assets are normally categorized according to liquidity. So obviously your cash would be first. Now all these numbers on here are summarized numbers, okay? I know, you might have 3 or 4 or 5 different bank accounts. You might have a petty cash account. All those different accounts are summarized in this line item called cash. And the total at the end of the year for 2016 was 574,143. Underneath that, this organization also had some investments, and basically what the board did years and years ago, they kind of squirreled away some money to set up an endowment, okay? And they've done quite well. You know, they've been able to build up their investments to $324,000 as of 12/31/16. Another asset line are grants receivable, okay? You might, you'll get grants during the year, and you'll spend money on those grants, and you'll be anticipating that, you know, your funding source is going to send you draws on those grants. Well, in this case, this organization has grants receivable of $64,728. You know, basically that's money that they're expecting to collect. They just haven't collected it yet. Todd talked a little bit about prepaid expenses. If you prepay your, you know, typical prepaid expenses could be like insurance or membership dues. You know, generally you pay for those up front, and then, you know, over time, those assets are used up. So as of this particular date and time, being 12/31/16, this organization had prepaid expenses of $7,670. So those four line items make up the current assets of the organization. Under that are some non-current assets. One of those being a deposit on leased equipment. There's, you know, I kind of scribbled in a note here that you can look for further information on that particular asset on footnote number 8, which is on page 10. And this organization also has some property and equipment of $14,121 at the end of the year. And again, there's more detail on that line item in footnote number 3, which is on page 9. So the total assets of the organization for 2016 total $986,215. Now we'll get into liabilities and net assets. Liabilities are things like accounts payable, which are certain amounts that are owed to your vendors.
I have a question about on the
Sure.
assets. What are prepaid expenses?
Okay, like I said, prepaid expenses can be things like prepaid insurance or prepaid membership dues.
But it's not like if we get a grant that's for next year or something, that we've got the money in the bank already, is that a prepaid expense?
No, that actually could be, well, we'll get into that. It's not a that could be a liability, actually. If you've received some money up front that you're going to be spending down the road, okay? That might be what's referred to as like a refundable advance or deferred revenue, okay?
Why is prepaid expense under the assets? What makes it an asset?
It's an asset because you've got, like, for your car insurance, okay? I just paid my car insurance last week, okay? Now, I'm gonna be using that, you know, that insurance policy is good for a whole year, okay? Now, I prepaid it last week, but it's not gonna expire until, you know, the end of next year. So that's worth something, you know? If I, you know, I paid for that last week, if I tell the insurance company I'm gonna cancel the policy, I want my money back, they're gonna pay me, you know, the remainder of my policy that I didn't already use, okay? That's an asset. Okay?
So do
Basically,
you put the entire amount of your insurance that you prepaid, or
No,
just the
you're-
part that comes in
you're-
the next year?
you're going to use up that, you're gonna use up that asset over a period of time, okay?
So is that money you paid last year? Like if this is 2016, did I make this payment in 2015? Or is it the payment I'm making in 2016?
Yeah, I prepaid the policy, okay?
So
I
maybe-
paid it last year, I paid it last month. It's not gonna expire till sometime in the future. You know, that still, that has a value as of right now.
When you say the future, do you mean the future in the next fiscal year, or do you mean
Right, right.
just, can it be within this fiscal year?
So maybe a real easy example of that, right? What I was referring to earlier as like getting like the early bird discount for paying, right? So let's say we run a calendar year organization, so our finances are January to December. So in December, I get my bill. In December of 2016, I get my bill for my 2017 insurance. So that's a 2017 expense,
That you paid?
right? But I decided to pay it in 2016 to get that early bird discount. But it's not, I'm not paying something that's a 2016 expense. I'm paying something that's a 2017 expense. So the fact that I already paid it, right? That now makes it an asset because I don't have to pay it
In which year?
I don't have to pay it in the year it's being used.
No,
I
no, no,
already
which year
paid
is it a prepaid expense in? Is
in
it-
2016.
Okay, thank you.
Right, so in 2016, it's a prepaid expense because it's actually for 2017, but I already paid it. So looking forward, right, it's not double the expense.
It becomes part of your
Yes.
2016 annual.
Right, because I actually paid the bill, it's got to appear, right, because I used the money. So like, we can't ignore that I spent some money, but because I spent it already for next year, it becomes a prepaid expense. So it becomes an asset, because now I get to 2017, I don't have to pay it. It's done already. But yet I'm reaping the benefit of it in that next year.
Is it still simultaneously an expense in the year that you did spend it in?
What was that?
Is it simultaneously also an expense in the year that you did spend it in?
Yeah,
Yes, a prepaid
2016.
expense.
Yeah.
Yeah.
Okay.
Another example, say your insurance comes due mid-fiscal year. So you've got 6 months in the fiscal year where it's an expense, and then 6 months in the next fiscal year where it's an asset.
Right,
So that's kind of it, so you
Yeah.
prorate it month by month.
right. Yeah, this financial statement on page 3, it's like a snapshot as of a particular date, okay?
But the date is always December 31st.
Doesn't have to be.
It's the last day of your fiscal year.
Oh, beautiful.
Right, it's the last day of your fiscal year, so whatever your fiscal year is.
I mean, you can generate this financial statement as of any date during the year that you want. Now, this particular organization, their year end is December 31st, but they could tell me, you know, we need a grant. We're getting a grant, you know, we need a financial statement as of November 15th. You know, give us a financial statement as of November 15th. So I could generate a financial, you know, they could generate financial statements as of any date during the year, you know, 1 day financial statement, 1 week financial statement. You know, this is a 1 year financial statement. You know, you can prepare financial statements, you know, for any period of time, okay?
Is it always a comparison statement?
Doesn't have to be.
Does it have to just be for the ending year? or-
Yeah, a comparative financial statement, you know, it gives the users of the financial statement more information, okay? Like if so, you know, if you go to a banker and give this, you know, say, I need a line of credit, okay? You give them these comparative financial statements, they're gonna look at 2015 and they, you know, they can compare the numbers 2015, 2016. You know, so it's just basically providing the users of the financial statements with more better information. You know, comparative numbers are always you know, preferred. Okay. Let's see. Let's talk about liabilities. Their liabilities are amounts that the organization owes to different vendors. You know, accounts payable. It could also be accrued payroll and payroll taxes. You know, you might. Let's say you work. You know, your payroll period ends December 31st. They're not going to pay that payroll to you until January 5th. Okay, so you've already worked that 2-week period to December 31st. The organization owes you that money. They're just not going to pay it until after year end. So, you know, that's an accrued expense at this particular time, December 31st. Same thing with accrued vacation. you might have, your organization might say that, we're gonna give you a week's vacation, for every, time period that you work. You might not use that vacation in 2016, you're gonna use it in 2017. But we still owe you that money as of this particular date, so we're gonna accrue that and show it as a liability. Okay. Deferred revenue, let's talk a little bit about that. You were asking about deferred revenue. In this case, this organization has grants. And basically what the grantor did was they said, we're gonna give you this grant and we're gonna give you like a $20,000 upfront money to provide financing to run that grant, okay? Now you only spent, say $10,575 of that money, so $9,625 of that grant has been received, but it hasn't been spent yet. It's gonna be spent in 2017, okay? So we show that as deferred revenue at this particular point in time, the amount being $9,625. Any questions, any more questions on the balance sheet or the statement of financial position?
One little additional note on the deferred revenue, and a place where it's kind of important to make sure you're showing that is in your New York State Council on the Arts grants. So if your NISCA grant contract year doesn't line up with your fiscal year, and they're funding you for a year's worth of activity, right, and let's say you get below 50,000, so you get that entire payment up front, you're gonna wanna represent that some of that money is being essentially held back to use in your next fiscal year, so that it's over the course of their contract year. So sometimes the funder's definition of their year doesn't line up with your definition of your year. And in that case, unless of course you've talked to the funder and they're okay with you using all of their grant in those first however many months in your fiscal year, but unless they've told you that's okay, it's usually a pretty good idea to show that you're being responsible and kind of, especially if you said this grant is to put on 2 shows and you've only had one of the shows, right? So you need to show we've held back, you need to demonstrate we've held back that money to put on that other show. So that's a place where deferred revenue would likely come in, for a lot of organizations, if your NISCA year doesn't, line up with your fiscal year.
And again, if you don't put on that second show, the funding source is gonna say, well, maybe we wanted some of our money back. So, that's why it's a liability. Okay. Let's stay on page 3 just for a moment here. Let's look at the total net assets line, okay? So we had, for 2015, we have total net assets of $824,864, okay? Again, that's our net worth at the end of the year, at that particular point in time. Moving forward to a year, the next year forward, we have total net assets of $871,939, okay? So in this case, the net assets of the organization went up. Now, how did those net assets go up? Well, if you look at the financial statement on page 4, it's going to reconcile those 2 numbers for you. It's going to show you exactly how the number increased from $824,000 in 2015 to $871,000 in 2016. You see those 2 numbers at the bottom of the financial statement on page 4. Okay, there's the same number for 2015, $824,864, and we moved that number over to 2016, and we had net income for the year of $47,075. So we add that net income to the net worth of the organization at the beginning of the year, and we come up with the net worth of the organization at the end of the year. So how did we get to that increase in total net assets of $47,075? Well, this financial statement is going to detail out the total revenues for the organization for the year, and then it's going to subtract out the expenses of the organization for the year, and it's going to come up with an increase or decrease in net assets. In this particular case, they had an increase of $47,075. Your total support and revenue at the top of this financial statement, it's made up of grants, membership dues, some charitable contributions. They had some special events. They also earned some money on training fees. They sold some publications. They had investments. So in this particular year, their investments increased, so they generated some income there. They also had some miscellaneous income. So their total unrestricted support and revenue for the year totaled $642,390. So if we subtract out the total expenses of $587,046, we come up with an increase in unrestricted net assets of $55,344. Now, because this organization has both unrestricted and restricted amounts, we have to break those out. Yeah, that's typical of not-for-profit organizations. So if your organization is generating both unrestricted monies and restricted monies, you have to keep track of that. You know, what's a restricted donation? Let's say somebody gives you a donation and they say, I want it used for, to buy musical instruments, or I want you to use this donation to buy a copy machine. That's temporarily restricted, okay? It becomes unrestricted when you actually use that money to buy the musical instrument or the copy machine, okay? So, again, it's very important for a not-for-profit organization to keep track of, restricted resources. Yes.
We talked about grants being treated as a liability. Is there ever a time when a restricted asset, the restrictions would be such that it would end up being a liability?
That kind of gets into accounting policies. Okay, it kind of deals with how you account for different grants. Now, you can get grants from governmental organizations. Okay, typically those are the government. You have to give the government a budget on how you're going to spend those monies. Let's say the government gives you a $100,000 grant, and they want you to spend this money on such and such a program. Okay, so. Let's say they give you the whole $100,000 on January 1st, okay? So on January, let's say on June 30th, you've spent half of those funds. You've gotten the whole $100,000, but you've only spent $50,000 of it, okay? So you're going to show the remaining $50,000 as a liability, as deferred revenue on your balance sheet.
Right.
Okay? Now that's one way to account for grants. There's another way to account for grants. Let's say a foundation gives you $100,000, okay, and they're going to tell you, okay, we want you to spend it on your music program, okay. Now, in a case like that, they're putting a restriction on that money. They want you to spend it on your music program, okay? So you've got the whole $100,000 up front. Basically, what you have to do is you have to account for that $100,000 as being temporarily restricted revenue. You're going to recognize the whole $100,000, when you receive it, okay? But it's temporarily restricted because you haven't spent it on the music program yet, okay? So let's say you've spent, as of September 30th, you spent 75% of it. So $750,000, $75,000 of it is spent. You're going to show temporarily restricted revenue of $75,000, or you can show unrestricted revenue because you've spent it, okay, of $75,000. You're going to show temporarily restricted, net assets of $25,000 as of September 30th, okay? And basically, that's it, okay? If you look at the financial statement on page 4, that you'll see this reclassification and kind of in the middle there, you show it as a positive number of $9,347. Okay? And down below, you'll see it as a negative number of $9,347,000. $9,347. Basically, that's what's happening, okay? They've gotten the money. It was all temporarily restricted when they received the money. They spent the money. In this case, they spent $9,347 of it, okay? And so they released the restrictions on that money, and we have in this case, we have a decrease in okay. Let me see if I can just explain a little better.
So that shows that the money was spent?
Right, the reclassification shows that you spent that restricted donation in accordance with the restrictions, okay? On this particular financial statement, just using round numbers, so you got $10,000, okay? On January 1st, at the end of the year, you spent $9,347 of that $10,000, okay? So you're releasing that $9,347 is released from restrictions, okay? So, we see it as a positive number above and a negative number down below. It's just a reclassification. You're just taking money from one pocket and putting it in the other, okay?
So the numbers in parentheses would be a realized loss?
No, it's not a loss.
Not a loss,
It's
but
just
it was spent.
It's just telling the user that you spent those restricted resources in accordance with the
Got it.
in accordance with the restrictions. Okay, so you're releasing those restricted net assets from restrictions.
And the contributions line, is that, like if there was $10,000 together, like that's like the 1,000 that's left over that you didn't use on those restricted areas? Or is the contributions line not related?
Well, it could be related, but in this case, we have two contribution lines. You'll see a contribution line up above there in the top section. Now, those are unrestricted contributions.
Oh, okay. I was looking at the one under
Yeah.
the
The 1,000, the 1,078. Okay. In this case, let's just go back to the number on page 3. Okay. If you look at the temporarily restricted net assets in 2015, we had $10,807. You see that? Okay. So those are assets that we've received from a funding source that we haven't released the restrictions in. We haven't spent those funds in accordance with the grant restriction, okay? In 2016, we spent $9,347 of that money in accordance with the restrictions, so we're gonna release, that's why the temporarily restricted net assets went down from 10,807 in 2015 to 2,538 in 2016, okay?
Thank you.
Okay, again, it's a little confusing, but,
That makes sense.
okay.
What's the 8269 in parentheses on page 4 under decrease, increase, and temporary restricted net assets?
Okay. The 8269, if you go back to the numbers on page 3, You see temporary restrictions in 2015 of 10,807,
Yeah.
and then for 2016 is 2538. If you subtract the
There's a
difference
difference.
between those numbers, is the 8,269
Okay, thanks.
on page 4. Going back to page 4, the statement of activities, in the middle there, we have expenses. Now, these expenses are kind of shown by their functional nature. The first line being program expenses, and under that is management in general. So your total expenses are $587,046 for 2016. Now, the detail of those expenses are on the financial statement on the next page, on page 5. So for this particular organization, they have salaries and wages, payroll taxes, employee benefits, they have accounting fees, advertising. There's a whole laundry list of different expenses there. Now, for not-for-profit organizations, typically, your funding sources want to know how you're spending the nature of your expenses. They want to know if your expenses are program-related or management in general related. So, that's why we break up the expenses into the various columns here. In this particular case, we have a column for total program expenses, a column for management and general expenses, and then a total column. And again, because these are comparative financial statements, we compare the totals for both years. One thing to look at here, your funding sources are going to want to, they're going to want to know that that their donations are being used for different programs. Let's say this organization runs a music program. They're going to want to see that you're spending their donation on music-related activities. That's what the program services column will show you. Okay. So in this particular case, this organization is spending about close to 90% of the donations on program-related expenses. They're only spending about 10% of their expenses on management and general type activities. Yes.
So for the salary, payroll tax, the employee benefit part of it, is that that people are specifically hired in to work program or management, or is that just a division, like you say, X percentage of your time is program, X percentage of your time is?
Obviously, if this is a school and you have teachers who teach guitar courses or whatever, that teacher is going to be all program related because the teacher teaches guitar. If you have an executive director who's doing wears various different hats, he's paying the bills, he's doing the cash flow projections and whatever he's performing some kind of management functions. Okay, so you have to come up with a reasonable basis of allocating his payroll to program related activities, management in general.
But to your point, absolutely, it's not a clear division per employee. I mean,
Right.
you're not either, especially in smaller organizations, you're wearing a lot of hats, right? So it's really just about sort of thinking about and tracking your time. We will not, in the interest of time, we will not get into the tangent of the overhead myth and how, the management of an organization, the accounting and everything else allows you to do your programming, whether or not it's specific and how we've been pigeonholed into thinking that's bad, but we'll leave that for another session.
There's a lot in the Philanthropy Today and Foundation World press about stop doing it. It's bad for everything.
Yeah. Again, just looking at this financial statement, anybody looking at this organization, they're going to want to know that, any kind of, that this organization is providing, service in accordance with their tax exempt purpose. So, this presents a good picture. I guess if you're probably spending 30, 40, 50%, anything over over 30%, it might raise some red flags. If you're spending those resources on like management in general or fundraising activities, you know, that might, you know, some people might kind of look down on that, okay?
Or look at the 990 and see
Right.
that one question about the percentage charitable contributions.
Yeah, if
They're
you're,
public charities, basically, yeah, charitable trust.
And fundraising does fit under that management in general.
in this particular case, they did not break out fundraising,
But it does, I mean, that's pretty much right.
but you can, yeah, there can be another column here just for fundraising activities. Okay. Page 6 is the statement of functional expenses for the previous year. On page 7 is the statement of cash flows. And this kind of goes along with what Todd was talking about. Now, this is looking back in time. It's not looking, you know, projecting numbers, you know, ahead like Todd was talking about. These are actual cash flow numbers for 2015 and 2016. So basically what this cash flow statement does, it takes your net income or loss of the organization on an accrual basis of accounting, and it reconciles that to the change in cash for the year. Now, the numbers at the bottom there are the cash numbers, and you know, I kind of referenced page 3. I circled that. So you'll see those numbers on the balance sheet on page 3, the 585,899 and the 574,143. Those are the actual cash numbers at those particular points in time. You know, so how did we get from the 585,899 in 2015 to the cash of 574,143 in 2016? Well, this statement's going to show you how they did that. Okay, we had net income of the year of $47,075, and then we're adding back depreciation. We're adding back depreciation of expense because that, you know, depreciation is like a non-cash expense. So we're going to add that back to cash. That amount was $9,506. We had some, you know, this particular organization, they had some unrealized gains on their investments of $19,755. We're going to subtract that out because even though that $19,000 is included in the $47,000 above, you know, it's not a cash number. So the key lines on this financial statement that a bank or a funding source would look at, they're going to want to see net cash provided by operating activities. In this case, it's $31,718 for 2016. Okay, so this organization did pretty well. You know, they generated cash from their operating activities of $31,000. And then underneath that, they also had some cash flows in and cash flows out from investing activities. They purchased some investments, they sold some investments, and they purchased some equipment, $388. So they had net cash used in investing activities of $43,474 for 2016. So if we take the net income of the year, the top number of $47,075, and we add the net cash provided by operating activities of $31,718, and then we subtract out the net cash used in investing activities of $43,474, we come up with a change in cash for the year of $11,756. We subtract that number from the cash at the beginning of the year, and we get our cash number at the end of the year. Again, on pages 8, 9, and 10, these are notes to the financial statements, and the notes just talk about the organization a little bit on the basis of, you know, the accounting policies, and they expand on some of the account balances in the financial statements themselves. So that's basically it for the financial statements.
Let me jump in here for a second. There were a lot of good questions, as you might expect, considering what the subject is. But of course, that means that we got a little slowed down on the presentation. I think that was a good choice because we were able to go deep on some of the things that you really needed more information on. It's 7:30, and there's an entire 990 that's in front of us. And so let me offer you this option. We're more than willing to come back with another session on the 990 because there's so much involved with that, and we want to make sure we don't, not do it justice, right? So we can send out, we've got all of your RSVPs, and we'll try to pick a date that's especially good for the folks who were here, who took time to be part of this. In the meantime, though, I know that from the county perspective, there were a couple of things that you were seeing as, errors on the 990. And so perhaps we can just maybe highlight a couple of those to leave people, in case you can't come back for the next session, with a couple of high-level things to be thinking of so we can target a little bit of the end, and then we'll come back with another session on 990, because clearly you all are just so excited that I know we'll come back for that.
The 990 was due already though, right?
Right, but the theme, and then I'll let you, the county folks jump in, was that there were some, again, when we put these together, it means that the county is seeing trends across multiple organizations, and one of those trends were some errors in our 990 filings as cultural organizations. And so those were the sorts of things we wanted to try to get into and highlight the different areas of the 990 and where we had to make sure we were sort of paying attention to. But if we could maybe have just a couple examples quickly.
Okay.
I don't want to put you on the spot.
That's okay, I'm sorry, I don't have my spreadsheets, I can show you all the. Number one, look at your mission statement, because your accountant or auditor or bookkeeper is filling in that spot. And the worst one we saw is, on the 990, where's your mission? Art.
Oh, geez, really?
I mean, you're not selling yourself to anybody saying that. And there are 3 places in the 990 where you can describe what you do. Use every possible spot to tell your story. Strut your stuff. You have good things to say, make sure you use those opportunities. Number 2, the conflict of interest, policy forms, etc. We've had a couple of organizations say they collect 0. That is not a good answer in New York State. Might be okay in Idaho or something, but it's not okay in New York State. There are a number of questions about governance that have a couple of sections to them. Do you do this, this, and this? You can answer no, because there are 3 parts. And maybe no only related to one of those parts. So but look at the words, read them, because it will reflect back on how well you're answering the same question in your application to the county.
Right.
So it might be accurate to have said no to the IRS. It's not accurate to say no to the county because we are looking at your bylaws and it's not matching. Or we're looking at your essay questions and it's not matching. So it's the inconsistency I'm trying to point out.
So if our accountant fills or does our taxes for us, we should look at that before it's filed and tell them to change things?
And your minutes of your board meeting should say that the board reviewed the 990, has approved the 990, and just as an example, a fairly large organization in Buffalo, I happen to have been on the board, and we were given the 990 by email in advance. If you have any questions, contact the finance person at the organization. Well, I didn't have finance questions. I had the kinds of questions I just illustrated. And I told the board chair in advance that I was going to bring up some issues. And I tried to be humorous to begin and said, the good news is we answered the question correctly about revenue from indoor tanning salons. We don't have any revenue from indoor tanning. Why did the IRS ask that question?
I know,
Not
it's
for profits.
bizarre, isn't it?
It is bizarre. So everyone laughs. I go through my things, and the eyes are rolling, and people are looking at their watches. And at the end of it, the former managing partner of a major major accounting firm in Buffalo said, she's absolutely right, every one of these, we're going to send this back to our auditors, they're going to redo it.
It
So-
took us several years to get the New York State to understand that we don't sell cigarettes.
Nice.
Yeah, okay. So the good news is that everyone in this room is going to make sure they've read every word, read every question. The IRS tries to trick you and change questions that used to be yes answers to, if you make the question now a negative, it's now a double negative, so you're supposed to answer no instead of yes. And we have, as of next week, new changes to the Nonprofit Revitalization Act, which is a New York State thing. I've only briefly skimmed what those changes are, but you really, really, really want to read it yourself as the executive director, but every board member, it's their duty to read it, and for the board chair who signs it under perjury and opportunity to go to prison, you sign that document.
And I think
You want to make sure it's accurate.
as an executive director, as a staff member, what Catherine just said is one of the best tools in our arsenal on this. The fact that this is signed under penalty of perjury, right? You have to look at it. You have to actually make sure that it's correct, right? And that idea that this is, that the 990 is a document, that Michael prepares for ASI, that's not true. This is a document that Michael and I prepare for ASI. Because going back to the mission statement, or on the second page of this, if you go to your 990, this, what looks like this big blank page, they're asking for your largest expense categories. And they're asking for a description of what you did.
And we'll see not-for-profits leave those areas blank or lump it all into the top section. You go,
Right.
I'm sorry, you have an educational mission, but you don't list anything in your top programs that relates back to education.
Right.
That's the disconnect.
Right. Now, Michael's not going to be able to prepare that section for me, right? He doesn't know, look at me giving him a bunch of financial documents, he's not gonna have that description of the program, and nor should he assume that every year for the next 35 years, it's gonna be the exact same description, right? So it has to be a collaborative process in terms of filling this out, and then it has to be reviewed. And your board may send it to an audit committee, or maybe the full board of it. So who does the review is, it might change within your organization, but there absolutely should be a review before it's sent in. It's not that you want to review it after it's sent in, right? I mean, you want to review it and make sure it's correct before it goes in.
But you also have to answer that very question. What is your process for
Yes.
the review of the Auditor 990?
Yeah.
And basically, what I do is I send, I prepare the tax return, I send Todd a draft copy,
Right.
I send Todd, a copy of the tax return marked draft. I tell him to share this with his board and let me know if they have any questions or comments, anything needs to be changed, so.
Two quick questions. So firstly, if there was an error, like if we go back and we can compare what was submitted already to the state versus for now for Erie County, is there a fix now? Because it's already been
Sure.
turned in.
In the application, what else would you like to tell us?
Gotcha.
And
Okay.
say, and then you send an amended 990 to the state or to the IRS too.
Okay. And then the second question is, do we hear back from Erie County if something's wrong with the 990? Like in the evaluation that comes back to us, the feedback?
Okay,
Is that ever in there?
so last year we really wanted to get the organizations ASAP because they'd be working on the 990 for the next year, and rather than wait a whole nother year for them to correct that, unfortunately, we were not allowed to send those letters out.
Okay.
So we are meeting with a few organizations that really had some issues with their 990s or some other document, not to penalize them, but to help them learn from what we, doing deep reads of all these documents simultaneously, we're calling it your annual checkup.
Okay.
So it's sort of like you go to the doctor and they look at all those numbers, we're looking at all your governing documents, your essays, your documents that are publicly available, and seeing, is there an internal consistency? Do what you tell us in text match up with the other language that happens to be numerical language that match up with the word language, and support each other and tell us that.
Okay.
And
But that's
that's
only
a-
a few agencies, like a few.
We picked a few, we would really like to do more because they've gone so well for both sides, because the county is also learning from the conversation that maybe we phrased the question incorrectly, or we didn't ask a part B to something that should have had a part B, or, so it's continuous improvement for all of us.
And keep in mind too, that as you're working on your accounting application, as you're working on any grant application, this goes back to the governance session we had, or when we teach about grant writing, it's puzzle pieces that have to fit together, right? And so as you're crafting your narrative for any grant, we'll take it away from just the Erie County grant, and you're representing certain things about your organization, its governance, its programming, And then you're submitting a whole set of supporting documents, and even the things you don't submit but that are publicly available, like your website or your social media. Make sure that what you're saying in your narrative is backed up with your supporting documents, with your public persona. You know, take it away from finance. If you say, well, we don't really spend money on marketing, which is what a lot of organizations, we don't spend that much money on marketing, but boy, man, we got this social media thing down. And I, as a grant reviewer, go to your go to your Facebook page, and your last post was from 3 months ago.
Or 3 years ago.
Right, but your last program was a month ago. Well, you're not really backing up what you're telling us. And so the 990 is part of that, right? Your annual budget is part of that. If you say, oh, you know, we're gonna, man, next year, don't worry. I know we haven't been great at individual donations, but next year, man, we're launching a new program that's gonna be amazing. And your budget doesn't show that you're gonna have any more money from individual donations. Well, you just said that because that's what the reviewer wanted to hear on the application, right? Or you're not holding yourself and your board accountable by putting it in your budget and saying, we are gonna do this, right? So it's about fitting that all together. And so, you know, we also wanted to get these sessions in a few weeks before the grant was due, because now as you go back and work on your county grant or any grants, it's about, so this is a good time then to take your 990 as one of your supporting documents and take a look at it in the context of what's being asked. And at the very least, you know, if it's certain things like, oh, we need to do a better job at really fleshing this language out, well, all right, we make a note of that and we make sure we do it for the next one. You know, there may be certain things that rise to, we better submit it and amend it, and certain things that are just, we're gonna do it better going forward. And that, one thing I will say about the county is that it seems like a really good answer, and please correct me if I'm wrong on this, is we're working on it.
Oh,
Now that can't be the answer for 15 consecutive years, right? but I mean, like, you know, if your answer is...
You're being thoughtful.
Yeah. So it's not done yet. Like, yeah, okay, this wasn't great this year, but we've got it on our list and it's going to get better. And then there will be people like Catherine and her spreadsheet that will check it next year to see if it got better. But as long as you're working on it, same thing with all that governance stuff and some of you were in that room. You know, that's a lot. That's a lot to implement. It's a lot to put in. But I think the fact that you're aware of it, you're working toward it, first off, for your own organization, it's very good. But secondly, even then for the funders to let them know that you're moving in that direction.
The Form 990, it's not a tax return, it's an information return. So, you know, it's meant to provide information to the general public, you know. The public wants to know what the organization is all about, what the programs are, you know, so, like you said, tell your story.
My question is, what's the difference between the 990 and the 990 EZ?
Oh, 990.
Is it easy?
It's easier.
Yeah,
It's much shorter, yeah.
And is it equally acceptable?
Well, it's gotta be.
Well, because you're only required if you have certain threshold of income.
Threshold,
revenue,
yeah.
And not as helpful to us, I'll say.
Okay. But you don't discriminate against
No,
them?
no.
No, I didn't think so.
But I also wanted to ask the question of Mike, thank you. Given the threshold changes by New York State for organizations that are required to have audits, that if an organization, say, is at 500,000 in annual revenue, and over the years they get better and stronger and have more employees, et cetera, and all of a sudden they're an organization of $1 million annual budget size, but they haven't been doing audits because it wasn't required. How would you, as a professional accountant/auditor, respond to that organization who says, I want you to now be our auditor? How would you feel about taking that account?
Well, I guess what we would do is we would tell the organization, you know, New York State rules require that you have an audit, a full-blown audit. If you're just going to be submitting a review or a compilation to New York State, you know, you're probably gonna end up getting some feedback from New York State saying that this is not acceptable. So, you know, you might be looking at, you know, either comply with New York State regulations and have your audit done, or else you might be out of business.
Or,
You know, because New York State could take your charter.
charitable status.
Your charitable status.
So what I'm more worried about are organizations that say, in the short term, we can save money by doing a review, because we're not required by law to have the audit, all of a sudden they meet that threshold where they are required to have an audit, but they're missing years of records. So how do you recreate those records in that gap? If I were a firm like yours, I'd say, oh, I'm not sure I want that client.
Well, there's different ways to attack that. I mean, I did have it was actually it was a school that actually was in a situation where they had audits done years and years ago.
Mm-hmm.
They stopped having audits done, and they just had compilation done.
Just a
basically.
compilation, right?
Compilation and review done. And so basically, they wanted to get back into having an audit done. So what we did was we did a balance sheet only audit.
Interesting.
We did a balance sheet only audit for, as a starting point, okay? And then going forward, the next year, we did a full-blown balance sheet, income statement, full-blown financial statements.
But it gets tricky. So organizations, if you think about, oh yeah, you don't have to do that anymore, it could create problems later on.
I could just share something, and I have to be very general in how I share it, but from some direct experience of my own with an organization that had been maybe a little relaxed about some things because they could, and then they got a grant that required an audit for closeout. It was a government grant. And the government withholds a certain chunk of change until you do the closeout audit. It's also the kind of grant where you might like to have more of them in the future. So like the government is going to look at your performance on the first audit in terms of, or the first grant, in terms of assessing if you're going to get future. Well, anyway, they were missing years of, for instance, banking records and things. So I had to go to a bank here and put in an extensive research request to get copies because they didn't even have necessarily like receipts that would be backup, for instance, for expenses. So we did a reconstruction that way, and it certainly ate into the holdback.
Painful. Thanks for sharing this.
So any other final questions before we break for the evening? Thank you everyone for coming to this.